What comes to your mind if you heard central banking in the new normal? Is it increasing the number of bankrupt businesses, or is it decreasing job opportunities? Well, let me share to you more about the central banking in the new normal. During March 16, 2020, the Philippines imposed lockdown and restrictive containment measures due to the COVID-19 pandemic. The pandemic has a big impact towards the Philippine economy. The domestic demand, the consumption, and the capital formation decreased. The government spending increased, the imports of goods decreased, and the economy shrinks by 9.5% in 2020. For production, the industry and services dropped, while the business closures increased and business trades were limited. The pandemic left a mark on domestic financial markets. The Philippine Stock Exchange Index declined to an 8-year low in March 2020. Meanwhile, the Philippine peso remained broadly stable, although the foreign exchange volatility increased sharply for the ASEAN 4 economies in March to April 2020. The Philippine peso was the least volatile. The central bank as crisis managers are responsible for ensuring sufficient liquidity, restoring market confidence, alleviating financial market stress, supporting economic activity, and developing guidelines or frameworks of effective crisis response under the new normal. But during this pandemic, did the central bank carry out its task effectively? Well, the Bangko Sentral ng Pilipinas responded quickly and decisively. In 2020, the policy rate was reduced 5 times for a total rate reduction of 2 percentage points. The reserve requirement ratio of universal and commercial banks has been reduced by 2 percentage points from 14 to 12%. The BSP also participated in the secondary market of government securities under open market operations. Although the pandemic was devastating, it offered us valuable lessons about how to handle a crisis. First is act fast. The BSP's intervention was aimed to reestablishing trust in the markets, ensuring adequate liquidity, and preventing liquidity strains that may lead to the bankruptcies, defaults, and other negative consequences and layoffs. Second is strengthen defense. The best line of defense against economic shocks is always strong macroeconomic foundations. Third, stay focused. Monetary policy is still centered on keeping prices low and steady. And lastly is to act together. The monetary policy and fiscal policy should be coordinated. So, I am hoping that I've met your expectations or the lessons you need about central banking in the new normal.